everyone, it's Monday the 20th of May 2024 and my name is Julius de Kempenaer and we're back on Stockcharts on the YouTube channel of Stockcharts. For those of you who missed me, sorry about that. We've been on a hiatus for a couple of weeks, 2 months I guess, and that was during the kind of reorg that we had here at the channel, but no worries. The plan is for me to be back here on a weekly basis, usually on Mondays, with an overview of sector rotation, relative strength, and obviously RRGs we're going to talk about. Let's dive right into what's happening right now, and because it's been a while that we spoke and that I gave you my view. Maybe you followed the blogs on Stockcharts, but if we look at sector rotation right now, there's an interesting situation going on. Obviously, the S&P is jumping to new highs. We just broke out to a new high. That is bullish. There is no doubt about it. But how sustainable is it, and how good is the quality of the breakout? That's what I'm asking myself. And in order to do that, I want to talk you through some of the observations that I'm having from a sector point of view and also on the S&P chart itself. If we start at the sector rotation, so we got the RRGs here. So here's the weekly RRG on the left and the daily RRG on the right. And if we start with the weekly version, then you can see how energy is still a very strong sector. It's pushing into the leading quadrant. So that is ongoing for quite some time already. Look at how long these tails are. The same goes for utilities. That's a really long tail, and long tails indicate that there is a lot of power behind the move. Please bear that in mind. Another one that is moving at a strong direction is consumer staples. Not as long as a tail as utilities and energy, but nevertheless, it's at a good direction. And then we have a few other tails that are moving in opposite directions, and I think that the most obvious one that we need to look at is consumer discretionary. That's right here, moving further into the lagging quadrant. Not a long tail, but at the direction that is indicating weakness. And then we got technology right here, which rotated from leading through weakening into lagging, picked up slight momentum over the last, well, basically 1 week, but moving lower on the RS ratio scale. And then we've got healthcare, which is inside lagging, but just picked up a little bit. And those of you who've seen me and followed my work, I pay a lot of attention to offensive versus defensive sectors. And traditionally, the defensive sectors are utilities, staples, and healthcare. And I think that right now you can add energy as well, especially when you look at, for example, something like beta. Low beta equals defense, high beta equals offense. And if you look at the beta of energy, that's definitely a low beta sector. So with energy, utilities, staples, and to a lesser degree healthcare picking up relative strength, that is to me an indication that the market is rotating out of, well, basically rotating into defensive sectors. And strength of defensive sectors usually happens when the market is in trouble. Usually happens when markets are, well, in a downtrend or are under pressure. Obviously, that is not the case right now. S&P is breaking to new highs, so the market's definitely not under pressure. But when you look at the rotation here, and you're going to see where that strength is coming from, and just look at the last 5 weeks and let's go rank it on percentage change, then you see that utilities is the strongest sector over the last 5 weeks. That tells me something. And then here is staples, that's the second, and then financials, that's not really defensive sector, but here's healthcare. So all three of the traditionally defensive sectors have pushed the market higher. That means that the rally, or at least a big chunk of the rally over the last few weeks, is being carried by defensive sectors. That is money flowing into these defensive sectors. That is not something that I necessarily associate with a strong bull market. When I go over a few of the other tails, they're less strong, they're less pronounced, but nevertheless, they're giving us interesting clues. A sector like materials, which is also an offensive sector, inside leading, but already starting to roll over. Same goes for industrials, already rolling over. The entire picture does not mimic, does not align with a super strong underlying market. And that's something that I gotta keep in the back of my mind, and that keeps me on my toes. At least there is some sort of caution going, despite the very clear breakout in the S&P 500. If we take that to the daily RRG, then you can see how some of these sectors are aligning with their weekly tails, but others are going in opposite directions, creating some sort of a confusion. And confusion is something that investors don't like. We like stuff that is predictable, that is moving in trends, all that kind of stuff. And sometimes that's not happening. If we do the same for the daily tails, then you can see how technology moved into the leading quadrant. That's causing that little hiccup right here, but it's now starting to lose momentum. By the way, in terms of offensive and defensive sectors, I think that technology is very interesting, because especially during the pandemic rally, there was this whole thing about technology becoming a defensive sector. And I think that if you look inside the technology sector, then I think that we can say that large cap tech or mega cap tech might actually be more of a defensive play, but there's definitely a ton of second and third tier tech stocks that are definitely not defensive plays. They're very offensive plays. So for the technology sector, that's now very often qualified as an economically sensitive sector. So it has two parts of the equation. It's got an offensive part, it's got a defensive part. Real estate, same story here. It moves into the leading quadrant, and on the weekly it's going in the opposite direction. If you look at communication services, picking up right here, and that's in line, it's getting back in line with that tail, with that hook that you see on the weekly. Communication services is also a sector that's interesting from an offensive, defensive point of view. A few of the entertainment industries, the internet-related industries are definitely offensive. But the pure telecoms, the wireless telecom and the fixed line telecom stocks are definitely defensive. And remember, the old telecom sector, was when it wasn't communication services, when all the internet stuff and the entertainment stuff wasn't in telecom, was really a defensive sector. So the characteristics on a sector level have changed, but they're definitely still there when you dive into the sector and look at the industries that are in that sector. We look at utilities. You can see how that is made a very strong move. It's very high on the RS ratio scale. But look at how this tail is now very short and very high on the RS ratio scale, meaning that there is all possibility for the utility sector to curl back up and get back in sync with that strong rotation on the weekly tail there. Same goes for consumer staples. It's inside weakening, it's leveling off, it's starting to pick up slightly. It's not as good as utilities, but you can see how it's starting to pick up. And as soon as that is getting back in line with that weekly tail that we saw on the weekly RRG, then you got two sectors, utilities and staples, that are moving back in sync on the RRGs. Here is energy getting back in sync again, powering up that very long tail that we had on the weekly RRG. Here it is. And now we got, and this is an important one, here is consumer discretionary. Look at that tail. This is shouting negative. This is shouting underperformance. This is shouting of a sector that is moving back into the lagging quadrant. And look at where the consumer discretionary tail is on the weekly chart, and you can see what I mean. So this is a very, very offensive. This is probably the most offensive sector that there is. It's inside lagging on the weekly at a very low reading. It just rotated back down into lagging, and on the daily chart, that tail is pushing further into the lagging quadrant, starting to help that weekly tail moving lower. So that is really, from a performance point of view, really weak. And from a sector rotation point of view, it's money moving out of offense. So I just wanted to point out to you that from a sector rotation point of view, I still have a few issues, a few items that are holding me back from being overly bullish. Now, with the S&P moving to new highs, there's obviously two ways that this situation can be resolved. Obviously, when the S&P holds, then eventually we will have to see this rotation, these tails, getting more rotational characteristics to offensive sectors, because otherwise market won't be moving higher. If you just think in terms of market capitalization, technology consumer discretionary, financials. These are very big sectors. We do need those sectors to move higher in order to carry the S&P 500 higher. The sectors that are doing it right now, energy, utilities, staples, are really small. Healthcare is a decent sector, but energy, utility, staples are really small sectors. So when these sectors are pushing the market higher, that is really, it indicates a lot of strength for those sectors, because if such a small market cap can push the market higher, that means that they're going really higher, and it means that the more offensive, bigger sectors are doing really bad. So that is the environment, that's the picture, that's the sector rotational picture that I'm watching for the time being. And obviously the other way that this can resolve is that the S&P 500 doesn't keep up and can't hold the breakout level and moves back lower, back in sync, what we're seeing on the sector rotation charts on the RRGs. Let's take this to the S&P chart itself. So this is $SPX, the S&P 500. And obviously here's the 4,800 level, that line in the sand. We broke that, nice rally. And then we put in a new peak here at 5,000, let's say 5,265. And then we drop back and we put in a higher low. That is a positive, let there be no doubt about it. And now we're about to break above this 5265. We're 5,300, so it's a decent level break. I already highlighted the sector rotation, which I think is not supportive of a sustained rally. Doesn't mean that it can't go higher, but I don't think it's a sustained rally. So what we're looking at is the quality of the breakout. And if we bring in a few other technical measures, so let's start with the RSI. We all know RSI, we all know how divergence is very often a precursor, a warning signal for a pause, a sideways move, and maybe even a bit of a decline. And what we see here is that that entire rally was basically supported by an RSI that made continuously higher highs, which is supportive of what we saw in that rally. And now in that decline, that RSI is nowhere near the level that we were, which was like 85, 86 in the mid of March. So in order for this RSI to put in a new higher high, we do need a lot more upside potential, or a lot more upside in the S&P chart. It is possible, but it is a lot of power. It's a lot of buying power, and I doubt whether that's going to happen. The same goes for the MACD. If you look at the MACD, you will find that this is also not yet confirming the previous high like it did right here. So these are, they are not showing a negative divergence yet, but the odds are that it will happen. These are situations where such negative divergences can very easily occur. Whether that's going to be when the S&P hits 5,400 or 5,350, I don't really know, but it's still, it's kind of, again, like a warning signal, a yellow flashing light that they're not confirming it. And then the one that I really want to point out to you is the volume pattern that we see in the S&P 500. If you look here, the basic rule for volume is that volume needs to increase in the direction of the trend. So in case of an uptrend, you want to see volume rising when the market goes up, and you want to see volume falling when the market goes down or when it's in a corrective move. And that's pretty much what we saw in this whole rally. So you see volume moving up in the rally, then it dips when there is a bit of a consolidation. Then you see in general that these bars are getting higher during that rally. Then there is 2-3 weeks of consolidation, and you see the market, volume stalling. And then in the last bit, you see volume rallying again. And then in the last bit here, you can see how this rally, this last bit here, volume is falling. And now the situation is turning around. So in the decline, you can see that volume is rising. So we now had the last decline took place on rising volumes. That's opposite of what you want to see in a bull market, in an uptrend. And what you also see is that the last two bars, volume is declining. So out of this low here, so this rally here, even with the break, you see that volume is not reaching the previous levels. And if it's a really good breakout, you want to see a breakout in volume as well. You want to see volume breaking out as well, confirming your breakout in price. That's not happening. So on the pure price chart, we see non-confirmation in volume. We see potential negative divergence building up in RSI and MACD. And if I combine all of that together, then yes, I still see the breakout, but I'm doubting the quality of this breakout. So I wouldn't really jump on the bandwagon right now. I would like to see some more confirmation, some more things getting back in line, like the sector rotation getting back in line, like the volume pattern getting back in line, like the RSI and the MACD shrugging off that potential negative divergence. And then the final piece of information I want to share with you is the rotation in asset classes. I won't go over all the tails, but the most important ones obviously are for SPY stocks, inside leading but moving lower. For the time being, it's only a loss of relative momentum, but we're heading towards that weakening quadrant. On the other hand, we see the fixed income tails, which is government, corporate bonds and high yield, starting to move towards leading. This is an initial signal that fixed income and especially government bonds are picking up. And the best comparison that you can make is to look at the stock bond comparison in a direct confrontation. And that's the chart on the right. That's SPY versus IEF. And usually when the market goes up, this is an uptrend. So when the stocks go higher, stocks are beating bonds. And that's what we've seen for the biggest part here, especially since the start of the year. Here you see a breakout, but again, is it sustainable? Is it a real reliable breakout? And here again, here is the divergence much better visible than on the SPY chart itself, because here you can see that the RSI is not confirming the most recent highs in the SPY IEF ratio. And we're now breaking higher here. And again, this RSI is miles below the level that we had on these two previous highs. So we're making a third higher peak and a potentially third lower peak in the RSI. That's the stuff that I'm watching right now. It keeps me alert. If we have to throw the towel because sector rotation gets back in sync and all these potential divergences are shrugged off, I'm very happy to jump on the bandwagon. But right now I'm really careful with all that I see happening that is potentially lowering or doubting the quality of the breakout in the S&P 500. Time will tell. The good news is we're back on Stockcharts television, usually on Mondays, so next week we'll have more information. I hope you enjoyed the show. Let's know what you thought about it in the comments. And you can find my email address in my blog articles. Feel free to write me. I'm usually very available. Thanks for watching and looking forward to seeing you again next week on Stockcharts television.